Is the Phoenix office market on the cusp of a transformative shift? With a staggering $296 million acquisition, Southwest Value Partners is making waves in the Valley office market. Welcome to the Commercial Real Estate Insights Podcast. I'm your host, Steve Hamoen. Let's get right to it. Southwest Value Partners has made a significant move in the Phoenix office market with a $296 million acquisition that includes prime properties spread across the metro area. This purchase features a notable office complex in downtown Phoenix, highlighting the firm's commitment to investing in high-profile real estate assets. One of the properties included in this massive portfolio sale is Block 23, a 307,000 square foot office building situated in the heart of downtown Phoenix. This acquisition is part of a broader strategy by Southwest Value Partners to capitalize on the growing demand for office spaces in the region, despite the challenges facing the commercial real estate market. The Phoenix Business Journal reports that this acquisition by Southwest Value Partners underscores the resilience of the office market in Phoenix. Despite the broader market challenges, office sales in the area have gained momentum, indicating a strong interest from investors in the Valley's commercial real estate sector. This acquisition not only impacts the local Phoenix market, but also provides insights for commercial real estate investors in other regions, including those in Kitchener-Waterloo, London, and Cambridge, Ontario. As the demand for office spaces evolves, both Canadian and American investors are keenly observing these developments to inform their own strategic decisions. VanTrust Real Estate LLC is making headlines with a significant mixed-use development plan near the Hallbrook Office Center in Leawood. This ambitious project could potentially attract a major corporate headquarters to the area, stirring interest in the local commercial real estate landscape. According to the Kansas City Business Journal, the proposed development will feature a variety of buildings strategically laid out southwest of Interstate 435 and State Line Road. This move by VanTrust Real Estate is being closely watched, as it has the potential to reshape the commercial dynamics in Leawood. The development plan is part of VanTrust Real Estate's broader strategy to enhance the commercial appeal of Leawood by offering a mix of office, retail, and potentially residential spaces. This strategy is aimed at creating a vibrant community hub that could serve as an attractive location for businesses looking to establish a headquarters in the region. The project underscores the growing trend of mixed-use developments, which are increasingly favored for their ability to offer a blend of work, live, and play environments. In comparison, the Kitchener-Waterloo region in Ontario has seen a similar trend with mixed-use developments gaining momentum. Developers in this area are also focusing on creating integrated spaces that combine commercial, residential, and retail components. This approach is designed to cater to the evolving needs of businesses and residents, reflecting a shift towards more sustainable and community-focused urban planning. As developers in both Canada and the United States continue to explore mixed-use projects, the potential for cross-border investments grows. Investors from both sides are keenly observing these developments as they present opportunities to capitalize on the rising demand for integrated community spaces. The Leawood project by VanTrust Real Estate is a prime example of how strategic development can influence regional growth and attract significant corporate interest. A Nuveen affiliate has recently acquired an apartment complex in LaGrange for nearly $88 million. This marks the Chicago-based investment manager's second suburban rental property acquisition in the past year, highlighting their continued interest in expanding their portfolio in the multifamily sector. According to Crane's Chicago Business, this purchase underscores the growing demand for rental properties in suburban areas, as investors seek stable returns amidst fluctuating market conditions. The multifamily sector, particularly in suburban regions, has been gaining traction due to shifting demographics and lifestyle preferences. Investors are increasingly focusing on these areas as they offer a balance of affordability and accessibility, attracting a diverse range of tenants. This trend is also observable in regions like Kitchener-Waterloo, London, and Cambridge, Ontario, where similar investments in multifamily properties are being pursued. In Kitchener-Waterloo, for instance, the multifamily market has seen a surge in new developments, driven by a combination of population growth and urbanization. Developers are capitalizing on the demand for rental housing by creating projects that appeal to both young professionals and families. This mirrors the suburban Chicago market, where investors like Nuveen are actively seeking opportunities to tap into the rental demand. This trend is not just limited to North America. Cross-border investors are eyeing opportunities in both Canadian and American markets, recognizing the potential for growth in suburban multifamily developments. The acquisition in La Grange serves as a case study for investors looking to diversify their portfolios by investing in stable, income-generating assets across different regions. The Orlando area has seen a remarkable increase in large shopping center deals exceeding $50 million since the start of 2024. This trend, highlighted by the recent sale of Winter Garden Village for $165 million, marks a shift in the market dynamics despite a limited number of available properties for sale. Tyler Williams from GrowthSpotter reports that the Orlando market experienced 5 such transactions since the beginning of last year, which contrasts sharply with the previous 5 years where only 5 similar deals occurred. Brad Peterson, vice chairman at Colliers, notes that this trend is driven more by the strategic goals of companies selling these assets rather than specific market conditions in Central Florida. For instance, companies like Ohio-based SITE Centers have been selling assets nationwide to reduce debt, as seen with their recent sale of Winter Garden Village. The property, which spans over 629,000 square feet, hosts renowned tenants including Target, Lowe's, Old Navy, and several restaurant chains. Despite the challenging market conditions characterized by high interest rates, these large transactions continue to occur. Peterson explains that property owners with favorable interest rates have little incentive to sell, given the cost gap they would face with new market rate debt. However, there remains significant capital from investors eager to acquire properties, though the availability of such assets is limited. Interestingly, the increase in large shopping center deals does not necessarily equate to higher prices per square foot. As Lisa McNatt, director of market analytics at CoStar Group, points out, the average sales price for power centers over the last 12 months was $250 per square foot, up from $210 the previous year. However, this figure can vary widely due to the quality of properties being sold, with higher quality retail properties commanding higher values. As we look to the future of real estate, tokenization is becoming a key player in reshaping the landscape. According to John Stojan, in 2025, luxury and commercial real estate tokenization is moving from pilot projects to billion-dollar deployments. By turning property shares into blockchain-based tokens, platforms unlock fractional ownership, enable cross-border participation, and add liquidity to traditionally illiquid assets. 4 projects are leading this transformation: Multibank Group, Mantra Chain, Propi, and Hedera via Red Swan Commercial Real Estate. Let's start with Hedera and Red Swan Commercial Real Estate. Hedera, known for its enterprise-grade hashgraph distributed ledger, supports real estate tokenization through its partnership with Red Swan Commercial Real Estate. Red Swan manages approximately $5 billion in commercial real estate and operates Token Studio on Hedera, enabling fractional ownership and secondary trading of digital securities. This combination creates a credible foundation for real-world asset tokenization. Moving on to Multibank Group, in May 2025, this Dubai-based financial derivatives institution partnered with MAG lifestyle development and blockchain firm Maverick to launch a $3 billion real-world asset tokenization initiative. This initiative supports the Multibank Group utility token, offering staking, fee discounts, and early access to listings. It's a significant step towards institutional-grade property tokenization. Mantra Chain is another key player. It's a Cosmos-based blockchain designed for compliant real-world asset tokenization. In early 2025, Mantra signed a $1 billion deal with Damac Group to tokenize properties, data centers, and hospitality assets across the United Arab Emirates. This marks Mantra as a central hub for institutional tokenization in the Gulf region. Lastly, Propi is pioneering blockchain-based property transactions. By using non-fungible tokens to represent property ownership, Propi allows for on-chain transfers and global investor access. While its deal volume might not match the billion-dollar tokenizations of Multibank and Mantra, Propi is redefining how property is bought and sold in a borderless environment. The tokenization of luxury and commercial real estate is entering a new phase. Projects like those from Multibank Group and Mantra are executing billion-dollar projects under regulated frameworks, while Propi and Hedera demonstrate the technical infrastructure needed for global adoption. For investors, the appeal is clear: fractional access to high-value property, increased liquidity, and blockchain-verified transparency. Thank you for listening to the Commercial Real Estate Insights podcast. I'm your host, Steve Hamoen. See you on the next one.